Welcome back to the Deep Dive. Today we're focusing our attention on one of the real foundational layers of the Ethereum ecosystem.
Yeah, and the surprising high-stakes move it seems to be making toward the established financial world.
Exactly. We are talking about Consensys, the software firm that created the ubiquitous MetaMask wallet.
Ubiquitous is the right word.
It really is. So Consensys is reportedly planning to pursue an initial public offering, an IPO. And look, this is more than just another listing, right?
Oh, absolutely.
This is arguably the most significant piece of infrastructure in Web3 trying to, well, formalize its position as a global financial technology player.
And doing it with advice from the biggest banks on Wall Street, no less.
That's the kicker. Okay, let's unpack this.
Right.
Yeah.
So our mission today for you, the listener, is really to go beyond just the headline. We want to synthesize the financial ambition here.
Yeah.
The regulatory tightrope they had to walk, and crucially, managed to navigate successfully. And the broader context of why now. Why would a company like Consensys time this move right now?
Makes sense.
We'll look at that massive prior valuation, the traditional financial heavyweights they've brought in, and that recent legal win that basically unlocked this whole conversation.
And those advisors, I mean, that's the perfect signal of their intent, isn't it?
Totally.
We're talking JPMorgan and Goldman Sachs.
Yeah.
Names just synonymous with institutional finance, guiding a company that last time we checked was valued at a staggering $7 billion.
$7 billion, yeah.
So let's ground ourselves first. Who is Consensys, really?
Good question.
I mean, we know it's one of the pillars of the Ethereum world, founded by Joseph Lubin, who is, an Ethereum co-founder himself.
Right. Core figure.
But for most users, their main interaction, their touch point, it comes down to one thing, that MetaMask wallet.
Exactly. They call themselves an Ethereum software firm. So basically, they build the tools, the infrastructure that lets Web3 applications run. Okay. And MetaMask is that client-facing gateway. If you're doing anything in DeFi, buying NFTs, participating in DAOs, chances are, you're using MetaMask.
Yeah, probably.
So Consensys isn't just selling software. They're actually facilitating the flow of capital, of activity, right across the decentralized ecosystem.
And that functionality, that's where the real revenue potential's got to be, right?
Yeah.
But let's look at the financial blueprint they had even before this IPO talk started.
Yeah, the baseline, the starting point for their ambition really is that 2022 valuation.
Right.
Consensys raised $450 million in a funding round. That's when they hit that $7 billion valuation figure.
Wow.
But it's crucial, like you said earlier, to remember the context. That was near the peak, right? The peak of the last crypto cycle.
Definitely. So that valuation was probably based on like hypergrowth metrics common then in Web3 and VC.
Precisely. Which raises the crucial question that any traditional investor is going to ask now.
How do you justify keeping or even beating that $7 billion number now, 2 years later, after the market cycles we've seen?
That is the real trick, isn't it? That's what they and their underwriters, JPMorgan and Goldman, have to pull off. Because traditional finance, they usually look at companies based on predictable revenue, profit margins, a clear path to quarterly earnings, stuff like that.
Right, the usual metrics.
Yeah. And Consensys's revenue streams, they come mostly from MetaMask transaction fees, especially swaps, right? And staking commission fees.
Okay.
And those are inherently tied to the volatility of the crypto market. User activity goes up and down.
So not exactly predictable quarter to quarter.
Not in the traditional sense, no. Yeah. And that's why the strategic choice to hire JPMorgan and Goldman is so significant.
Okay, explain that connection.
Well, it signals they're not just looking for, quick crypto cash. They want institutional legitimacy.
Oh, okay.
They need guidance on how to package these, novel revenue streams into a story that institutional asset managers can actually trust, can buy into.
Right. Translated for Wall Street.
Exactly. These banks, they understand the rigorous public listing requirements. They know the risk tolerance of that traditional investor pool.
So those banks are essentially putting their stamp on it, saying, yeah, we think we can sell this Web3 infrastructure story to our, more traditional clients.
That's the bet they're making.
But to do that, they need certainty, right?
Yeah.
They need the company to be, squeaky clean.
Absolutely.
And this is where that massive regulatory shadow comes in. Here's where it gets really interesting.
Yeah, this was the big one. You can't really do a major IPO, especially not in, nascent financial tech, with a big regulatory issue hanging over your head in the U.S.
Makes sense. Too risky.
Way too risky. And for Consensys, that issue was a lawsuit from the Securities and Exchange Commission, the SEC.
Okay, what was the core of the lawsuit?
The SEC was looking really closely at the staking features built into MetaMask.
Staking, okay.
And the allegation was specific and, frankly, potentially company-altering. They claimed Consensys was acting as an unregistered broker.
Okay, let's clarify that for listeners. Why would facilitating staking through MetaMask make them a broker in the SEC's eyes? What actions cross that line?
Good question. It really comes down to two things: compensation and intermediation.
Okay.
So MetaMask offers this service, right? It lets users easily participate in staking, often via third-party protocols. The SEC's argument, basically, was that by taking fees or a commission for helping users move funds into these staking pools and actively promoting these services, Consensys was acting like a middleman.
An intermediary.
Exactly. An intermediary in what the SEC viewed as a securities transaction. And if you do that, you generally need to register as a broker.
Got it. So Consensys' defense must have been that they're just software, right?
Okay.
Not a financial intermediary actually holding the customer assets.
That's the core of it. They'd argue they're non-custodial. They don't control the user's funds directly.
Which is the standard defense for most Web3 infrastructure firms.
Precisely. But this lawsuit, it created this huge legal and financial risk. An IPO would have been almost impossible, or at least the underwriters, like JPMorgan, would have demanded a massive discount for that risk.
Right, the uncertainty factor.
Yeah.
So what changed? What was the turning point that suddenly made this IPO conversation possible again?
The turning point came earlier this year, back in February.
Fine.
The SEC actually informed Consensys that it planned to dismiss the lawsuit related to those staking features.
Oh, dismiss it.
Yeah. Now, whether that was because of, an internal rethink of their legal definition of broker or maybe some external political pressure, who knows? But the effect was clear. It removed the main regulatory hurdle for them in the U.S.
Okay, and the sources we looked at, they do tie that dismissal to a broader context, right? Mentioning a broader softening in U.S. crypto enforcement under the Trump administration.
They do. And as impartial reporters, we should note that observation from the sources. Because that political dimension, it's critical. It highlights just how fragile this regulatory environment still is.
Good point.
So while the dismissal is a massive win for Consensys right now, relying on a perceived political or enforcement shift, well, that introduces systemic risk, doesn't it?
Yeah, definitely. What happens if the political climate changes again, say, under a different administration?
Exactly. The enforcement strategy could potentially reverse, and those same tricky questions about being a broker could resurface, but this time for a publicly traded company.
Oof, that's a huge point. Public companies crave regulatory certainty above almost anything else. Operating on politically shifting sands is inherently risky.
It is. But for now, the path seems clear, and they're obviously leveraging that certainty to join what looks like a growing trend.
Right.
What's fascinating here, I think, is that the Consensys IPO plan isn't happening in a vacuum. It's not an anomaly.
Okay.
We should frame this as part of a larger market shift. It really seems like investor appetite for publicly traded crypto equities is improving quite a bit.
Equities, not tokens. That's key.
Right. Leading to what some sources are calling a fresh wave of crypto company debuts. It signals that the infrastructure layer of the sector is, well, maturing.
And we have seen some other big moves in this space already this year, haven't we? Giving Consensys some peers to benchmark against.
We have.
Like Circle, for instance, the issuer of the USDC stablecoin.
Yeah, a big one.
They had their IPO debut back in June, reportedly valued at roughly $6.9 billion.
Which is almost identical, interestingly, to Consensys' last private valuation.
Exactly. It gives institutional investors a direct comparison point, doesn't it, between two really critical infrastructure providers in the crypto economy.
It does. And then we also saw Bullish, the crypto exchange, list on the New York Stock Exchange in August.
Right.
So that shows some diversity in the types of crypto firms listing. You've got exchanges, stablecoin issuers, and now potentially core software middleware firms like Consensys.
So Consensys is joining a pretty select, high-profile group here.
They are. And the significance, I think, is that these are corporate equities, not token offerings.
Yeah, we keep coming back to that.
It matters because they offer traditional investors a regulated, audited way to get exposure to Web3 growth without the, let's say, complications and extreme volatility of holding decentralized tokens directly.
Right. It reduces the perceived risk.
Massively. And that risk reduction seems to be the engine driving this renewed institutional appetite.
Yeah, it makes the investment thesis much cleaner, much more familiar for them, instead of analyzing tokenomics or staking yields.
Which can be pretty opaque.
Right. Institutional investors are just evaluating a software company that charges fees for critical services. That's a model they understand perfectly.
Exactly. It fits their framework.
Okay, well, we've covered a lot of ground here. Let's try and synthesize the key takeaways. So what does this all mean for the listener?
I think it means we're watching potentially the final stages of Web3 infrastructure getting properly integrated into the traditional financial system.
Interesting way to put it.
Consensys, MetaMask's parent, they've done the necessary groundwork, it seems. They've secured the ultimate Wall Street seal of approval with JPMorgan and Goldman.
Check.
They removed that huge legal roadblock by getting the SEC lawsuit dismissed.
Check.
And now they're setting this ambitious 2026 target for their public listing.
So they're strategically positioning themselves, riding this wave of other crypto equities hitting the market.
Yeah, it feels like they're proving or trying to prove that the infrastructure layer of Web3 is finally seen as mature enough for that big public market spotlight.
Okay. So what's the final thought here? What's the bigger picture question left hanging?
Well, ultimately, the success or failure of these early public listings, Consensys, Circle, Bullish, it's going to dictate a lot more than just their stock prices, right?
How so?
Their public performance, and crucially, the ongoing scrutiny they'll face from regulators as public companies, that's going to fundamentally shape future regulatory appetites.
Setting precedents.
Exactly. That definition of an unregistered broker, especially in the context of non-custodial software, that's still a live, ongoing discussion. It hasn't gone away just because one lawsuit was dismissed.
Right.
So how Consensys, assuming they go public, manages its services and its compliance obligations under public scrutiny, that could establish foundational legal precedent for basically every other Web3 middleware provider dreaming of public scale.
So that's the critical story to watch over the next few years, how these newly public crypto infrastructure companies navigate the regulatory landscape.
Absolutely. It's a space investors, users, and regulators will all be watching very, very closely.